Hey everybody, it's me, Mickie Giacomini with Great Talks. And today, oh my goodness, we're going to talk about hard money loans. Yes, dispelling the myths, creating some clarity on what those really are. And I have with me a really great guest, Jay Robbins. He's going to share so much information with you. You are in for a treat. So let's bring him on. Hey, Jay, how are you?
Hello, everyone. It's nice to be here, Mickie.
I am so thrilled that you are here today
Thank you.
because so many people often ask, okay, what is this hard money loan thing? Is that like a loan shark or something? What is that? They just don't get what it really is. So, Jay, can you help us understand what is a hard money loan?
Sure. And you just used the word loan shark, and that's arguable because I'll first start out with sharing that a hard money loan is typically going to have a double-digit interest rate. But here is the simple definition in my perspective.
Mhm.
It's a short-term bridge. Sometimes it's called a bridge loan. So it's a short-term bridge to help you achieve what I call your money wellness, with the intention of it ending very quickly. Very quickly is relative. So it could be as little as 1 or 2 months, and it could
Mhm.
be as long as 3 years. I've seen this particular product go up to. But when the term ends, whether it's in 1 month or 3 months or 3 years, it has to be paid. Whether
Right.
you are refinancing or selling the subject property, when that term ends, that's why it's hard. It's a hard stop. You have to pay it.
Great. And a lot of times people do understand, oh, bridge loan, got that. But for some reason, when they think about hard money loan, they're just like, oh, but it's not like it's not something to be an affront to
Yeah,
at
I think
all.
yeah, I think, Mickey, it's like anything in life, right?
Mhm.
Which is, um, be clear on what you want to have happen. Like, one of the ways to help figure out what you want is to be clear on what you don't want. When
Right.
you're clear on what you don't want, you can then figure out what you do want, and then it's why do you want that, and then the plan happens. So if the solution to the person or whomever is looking into a hard money loan is a hard money loan, then you move forward if it makes sense. And most important in my world, if it feels good, given the options.
Yes.
Because
Right.
sometimes the option is don't do anything. That's an option, right?
Yeah.
And if it feels better to not do it, then you should go with what feels better.
Sure.
But it's important that if you're speaking to someone, you're sharing what obstacles you might be facing, and then then it gets determined if the hard money loan is a good fit for what you're wanting and why. And then as
Yes.
long as we understand the upsides and downsides, the
Hmm.
benefits or the potential consequences of the product, and then we still make the decision, then it's a good decision. And I think you can apply that to any area in life.
Oh, sure. Right. Absolutely. So, how would somebody be able to qualify for a hard money loan?
Sure. So in my experience, close to 100% of the time, a hard money loan is based off of equity, the equity position in whatever you're doing, buying or refinancing. The
Okay.
investor also wants to know that you have the ability to pay it. It doesn't mean they're
Mhm.
going to look at tax returns. They're not going to look at how you do income. It just needs to make sense because a hard money lender is not wanting to foreclose, although their guidelines are typically based off of foreclosure. Like if I have to foreclose, I need to know there's enough equity in the property to be able to quickly sell it and get my money back. Okay.
Sure.
So to answer your question, the way one qualifies is the amount of equity in the property. So if it's on a refinance of any sort,
Mhm.
typically in my experience, an investor wants to see 40% equity, 40. That's the general number,
40%.
right? Okay. And same thing with a purchase. If you're purchasing, they're going to want to see a 40% down payment. And as a
Mhm.
result, credit is not important. Almost everything is not important, and it can
Right.
close very quickly. So when someone, the borrower that a hard money loan is good for is someone who has at least 40% equity after the loan is taken care of with closing costs on a refi. On a purchase, it's the down payment of 40%. Now, there are some lenders out there that will go to 30% and even
Mhm.
25% equity
Okay.
position. But the general guideline is 40% with a closing in an average of about 10 days, give or take. Usually, the most time consuming part of a hard money loan is the time it takes to do an appraisal, but it can go very,
Mhm.
very quickly. So, essentially equity showing that you have some sort of cash in the bank after closing. Those are pretty much the basic guidelines for obtaining a hard money loan.
Yeah, that's interesting, because I do see that in my day-to-day relationships with some of my clients, in particular investors, especially my investor clients who are buying properties that they want to fix and flip.
Mhm.
So, and I know that those are a lot of the questions that do come up from the hard money lenders that they're working with. They want to know how much they will be able to recoup once they've fixed up the property and so forth. Are they really going to make money on it? Are they going to lose money? What's the scoop going to be? Those are some of the questions that some lenders will actually ask them. So is that something that you as well ask your clients that
Right.
are trying to get loans?
Yeah. So that's a good question. A hard money loan or a bridge loan is
Mhm.
different, and a lot of people don't know this. Falls under it's all under the lending is under the same umbrella. Said investor has money to lend, borrower needs the money for whatever reason. So now let's figure out what's going to be the best product.
Mhm.
There is a
Yes.
product out there called a fix and flip product. There's a product out there called a ground up construction product.
Mhm.
And then there's a product called a DSCR loan, which we'll get into in a second. It's a longer version. It's a longer, more conservative loan. So the when one is doing a hard money loan, it's because they need money very, very quickly within
Mhm.
approximately 10 to 14 days. And they're going to do something with that loan in the next year or less. That's why someone's going to do a hard money loan. If an investor is looking for a fix and flip product or a ground up construction product on the investment side is similar to the hard money, except there are more moving parts.
Okay.
Whereas on a fix and flip, the investor is going to give money for the acquisition as well as money to do the renovation, knowing that
Yes.
the investor is going to flip it, right?
Right.
So the rates on a fix and flip are actually similar to hard money.
Mhm.
Okay. Now, the equity position is a little different. The
Okay.
equity position on a fix and flip is actually more lenient than hard money because on a fix and flip, what an investor wants to see is you're going to acquire that property and then you're going to need money for renovation.
Mhm.
How much is this all going to be worth when the dust settles and you're ready to sell it or keep
Right.
it and refinance it? Okay, fix and flip, fix and hold. It's essentially
Yes.
the same. It's a short term product usually about a year, where money's given for the renovation, different from a traditional hard money loan.
Okay.
Okay. Yeah.
So
So,
now I believe I had a client a few months back. They were purchasing a new home, and what they did is so that they could go ahead and get into the new home and they still needed to sell their existing home. They took out a bridge loan at that time to buy the new home. And then once their existing home sold, then they were able to apply that toward the bridge loan that they
to
took
pay
out on
that
the
off.
new
Yeah.
home.
Yeah. The word bridge loan has several definitions, but the general part of it is you're bridging time to help satisfy what you want. Okay.
Yeah.
For example, if a borrower has, well, I'll give you an example. A borrower has a home that's worth $1 million. They own it outright and they
Mm-hmm.
need $500,000 right away.
Mm-hmm.
Okay. That can be a hard money deal
Okay.
and it's going to be quick. Like I have a hard money lender that will give terms of 3 months as an example, like pay it back in 3 months and you'll get this interest rate as an example, right? And so you're bridging that. On the other side of the coin, if you have a property and it's owner occupied and you're using the equity in your owner occupied property to do something else, whether it's be an investment property or owner occupied, that's not considered hard money because hard money lenders, in close to 100% of my experience, do not give loans to people on their primary residence.
Mm-hmm.
A hard money lender is close to 100% of the time only going to lend on a business transaction because it's not as regulated. A business transaction in real estate is a real estate investment property.
Okay.
Okay, because of the regulation, because if it's in a person's name or primary, then there could be a lot of gray and a lot of liabilities. And direct lenders are like, listen, we just want to lend our money and get paid and get out. And
Yeah.
that's the concept of a hard money lender. But it's
Yeah.
also a bridge because it's bridging time. So bridge can be a little
Sure.
confusing, but it's got, like I said, it has several different options that fall under that term.
I like the way you say that though, bridging time. I think that that makes a lot more sense,
Mhm.
right?
Yeah.
So it's not just bridging from one thing to the other, it's also bridging time. So
Right.
that
And
time
and
can
the,
be
and the service
there.
professional who really understands or is willing to take the time to deep listen to the person they're working with. It's to
Mm-hmm.
hear, tell me your situation
Yeah.
and let me see if I can come up with a game plan. And it might be hard money. It might be a home equity line of credit on a primary residence. There's a variety of things. It's just important to, as you know, to work with someone
Mhm.
who's comfortable with being direct and honest. And if they have, sometimes they'll have the product and sometimes they don't. And it's the willingness of the professional to let go and say, hey, here's the situation. Here's my service to you. Sometimes it means you have to go in a different direction. But it's just important to
Absolutely.
understand what someone wants to accomplish. And there's usually a
Sure.
product for that.
And that just builds trust because that lender, if you will, is showing the integrity of, hey, I either have the product or if I don't, that's okay, but I'll still help you get to where you
Right.
need to go so that you can
Right.
get it. And I mean, that can really that really just bridges that bridges a great relationship. Bum.
Which right,
Um,
which is what this is, right? For
yes,
any service professional. And by the way, if you're a real estate investor, you're a service professional. You've
sure.
got a business of real estate and you're serving an end buyer or a
Yeah,
tenant or what have you. And that is what I mean. Like I share with you, we take a spiritual approach to real estate financing. That's what I mean by showing up, having integrity, and the willingness to let go and not
mhm,
living in fear that this isn't about the money. Yes, we need to make a living, right? We need to put food in our refrigerator. I've got 2 young kids and a wife, and we need to, it's important in our
gotta
society.
eat.
We need to make a living. However, one of the reasons I've been in this business for over 2 decades, which I think all service professionals should just follow suit, is just be of service
Yep.
and know that it's more important to do what's right and act with kindness and compassion and integrity, and then
Mhm.
everything else will fall into place, i.e., going
Right.
back to what product is best suited for someone who wants or needs to do something.
Absolutely. I so pick up what you're throwing down there. I feel that way too. It's service first, right?
Yeah, which is
It's
look at the pot, look at what you're doing. You're doing this to add value. Maybe someone will say, "Hey, Mickie, I want to work with you." But a lot of people that are watching you, we know that most people are just going to watch it and get value, and it's one of the reasons we're
exactly,
showing up. So
exactly.
that's one of the
Just
reasons I'm
trying
here with you. I want to support you because I see what you're up to.
and vice versa. I mean, it's
Yeah.
just so important to just get it out there, educate people.
Yeah.
And some people are very well educated in these different realms, but maybe they just want to hear it a different way. They need a refresher, and that's okay too. Or maybe somebody has no idea. So, what I am curious about, let's before you go, could you go over a little bit about the upsides and downsides of the hard money loans? Like,
Yeah, yeah,
really good
absolutely.
for, what are they not so good for, or maybe some other
Right.
products?
Yeah. So a hard money loan, as I mentioned, it requires a large amount of equity, and so the upside of doing a hard money loan is you're going to get money quickly. That's the main reason you're going to one is going to choose a hard money loan because you're going to get the money quick. And when I say quick, it could be 7 to 14 days. Okay, that's the upside. The downside is that the interest rate is typically going to be in double digits, between 11 and 14, sometimes 15% or
Mhm.
more, depends on who you use. It's going to come with points because a private lender makes their money off of the closing when they're charging
Mm.
points because they know you're going to pay it off within a year or 6 months or 2 years. So they'll make interest off the money for a little while, but they know that it's going to get paid off, so it costs money. So the closing costs are higher, the interest rates are higher, and when you sign that agreement, whether it's again 3 months, 6 months, 12 months, 3 years, typically the only time I see 2 or 3 years is if it's on a development deal. Okay.
Okay. Yeah.
If it's on a single family home or a 1 to 4 unit like residential, you're probably going to hover around the 12-month mark almost all the time. If it's a
Mhm.
fix and flip or ground up construction, that can go 18 months, sometimes 2 years, just because of everything with permits and all that
Mhm.
stuff that goes with it. Um, but uh, but ultimately the downside is rates, closing cost, and that when the term is up, you have to pay it off. So
Right.
my suggestion, if you're doing that, would be to go into it um, with a game plan for exactly what you're going to do when the term is up, right? And that you're
Mhm.
having someone guide you through that. So upside, speed; downside, rates, costs, and the amount of time that you have to pay it off. But it can be perfect, and I do several of those per month. But because of the influx of investors on the market, private money, private equity, there
Mhm.
are other products that are a spawn or
Yeah.
branched off from hard money that are more in favor of the borrower, that has less of those downsides.
Sure. Absolutely. But it's funny because I hear you saying some of those downsides, like the double digit interest rates and so forth. But when you are looking for something that is a shorter term loan, you're not going to need that loan for all that much time. It really isn't, depending on the case, all that awful to have that. So, I hope people don't hear that and say, "Oh, I got to stay away from that because of it." No, 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 no. That's not the case. It could be a very beneficial type of product for you. Sometimes the interest rates, for lack of a better word, freak people out, and it really shouldn't.
Yeah,
So,
it's interesting. I did a video that is called "Why Rates Don't Matter." And it touches on what you just shared, because this comes down to math. And I just
yes,
shared with you the downsides of a hard money loan. But going back to what I was sharing before, it is my job and my commitment to be of service to understand what the person wants, just like you,
sure.
right? As a real
Yeah,
estate professional,
exactly.
let's hear what you want, right?
Hmm.
And and once someone shares what their situation is, like if they say, I need money in 14 days, or this is going to happen, right?
Yep.
Then there's two options. You do a hard money loan with the high rates and the high costs, et cetera, which is relative, right? I say the word high and
Hmm.
you're correct. That's relative. Or you don't,
Right.
right? The option is you don't. And so I would imagine one of those two happening and which one feels better for you to do.
Exactly.
And so the video that I did, "Why Rates Don't Matter," I'll simplify this. If And I've come across this scenario several times, that when someone says that rate is too high or that rate is great, it's very low, it doesn't matter, because if your intention, let's say, is to have a lower payment, let's say the payment is going to be $2,000. Okay.
Mm-hmm.
Um, and the interest, you need to have a payment of $2,000 for whatever reason. And the interest rate is 3.5%, but the payment is $3,500. That's an example that if you're getting a 3.5% interest rate, but your payment's 3,500, but you need it to be 2,000, it doesn't make sense. So the
Right.
interest rate is irrelevant. Now let's go on the other side. If you need to get something done and you need a payment of $2,000, and by doing a hard money loan at 12.5% with points, et cetera, you have the
Mm-hmm.
ability to take out the cash, and your payment is $2,000, even though your rate is 14% or 12%, but it accomplishes your objective,
Right.
then you move forward, even though the number is higher. So essentially, the point of that video, what I'm sharing with you, Mickie, is that the number of the rate isn't as important as what your intention is. And does a solution that's provided help you get to your intention? If it does, you move forward. If it doesn't, you do not move forward.
Exactly. And isn't the point to move forward? So
Right. Well,
learn about the different products.
yeah. I
Find,
mean,
and like you said, I was
yeah,
just gonna say, like you said, it's what feels good. What feels good
yeah.
to you. So,
Yeah,
and
well,
these are just the options.
yeah, and I'll share a scenario. I had a gentleman that was going to do a hard money loan,
Mhm.
and his options were to do it or not do it and try to sell. He was in the middle of renovation and he didn't get
Ah,
enough money and all those things, and so in my perspective, he's taking more of a risk by not doing the loan than doing the loan. However, what I feel really good about is I laid out the options and upside and downside. I
mhm,
shared, based on what I heard from you, this is
mhm.
what I would do. So sleep on it. And as I picked up something along the way. If you have to make a big decision, take as much possible time as you can until you have to make a decision. And that could be a couple of days. And one of the ways I make a decision, Mickie, if I can share, is if I have time to make a decision and it's really something important and deep, I'll go sit and put my back on a tree,
Oh,
and I'll get silent and I'll
yeah.
get quiet and I'll say, here is the option. Here are the options. What feels better? And then my stomach, intuition, gut, right? We call it
Mhm.
different things.
Sure.
When I hear the answer, when my body tells me, not my mind, because my mind has gotten me in trouble, right? And the pitch just by saying logic and mind and da, I'm 49, so I get to use my life wisdom of going with my intuition, and
Mhm.
that answer is
Yeah.
what I move forward with.
Yeah.
And I always share, as long as you, myself, and anyone else, as long as you understand the upside and downside, and you sit with it, you sleep
Mhm.
on it, and then
Yep.
you make your choice and decision. 100% support from me.
Yep. I agree with you 100. I really do. I'm a huge proponent for that sleep on it type of mentality, because a lot of real estate, a lot of times those are really, really big decisions to make. So it's really important to really just make sure it resonates correctly with you,
Yeah.
that
If
it's the
if
right
if
thing.
if given the option to take time, because as you
Yeah.
know, in our business, sometimes we don't have, like, it has to
Right.
be like, make a decision or you lose
Oh, yeah.
this opportunity.
Yeah.
And as you know, some people are uncomfortable with making that quick decision and they lose out on the opportunity, and then they have to learn the next time and that sort of thing. But it's just all part of life. We're all just trying to figure it out.
Sure. Well, Jay, I'm so glad you came on today to help us figure out more about what hard money loans are.
Yeah.
And again, what is the name of your video that you have out on interest rates?
Oh, sure. So the website is koarivercapital.com. Yeah,
KOARivercapital.com.
KOA rivercapital.com. And if you click video library, there's several videos on there. And one of those videos is called Rates Don't Matter. And there's some other videos on there that are specifically designed for real estate investors. But you
Excellent.
can go there and hopefully that'll add some value to you and your listeners.
Okay, I will try to drop that in the description. And for those of you who are interested, reach out to us and we'll make sure you get that link Thanks so much for being with us today. And
Thank
thank you
you.
all for watching.
Thank you. Good luck to everyone.
Thank you. Bye-bye.